Warren Buffett said, buy index funds. Warren Buffett said, be fearful when others are greedy. Warren Buffett said his favorite holding period is forever. And millions of regular Americans have taken this advice and tried to apply it to their financial lives. Because if it works for the richest investor in history, it should work for everyone. Except it doesn't. Not exactly. Not in the way most people think. Warren Buffett's publicly stated advice is not the advice he actually follows. And the gap between what he tells regular people to do and what he actually does to build wealth is so large that following his public advice while ignoring his actual strategy might be one of the most well-intentioned mistakes in personal finance. Today, we go through specifically why Buffett's advice, taken at face value by regular people, is less useful than advertised, and what understanding his actual strategy reveals about building real wealth. The index fund advice: right conclusion, wrong reason. Buffett famously recommends that regular investors buy low-cost index funds. He's right. For most people, low-cost index funds are the optimal investment vehicle. But here's what he doesn't say. He has never built his wealth through index funds. Buffett built his fortune through concentrated positions in specific undervalued companies, negotiated terms unavailable to retail investors, business acquisitions with structural advantages, and access to capital at costs regular investors cannot replicate. When he tells you to buy index funds, he's not telling you what he does. He's telling you what he thinks you're capable of doing well. That's a compliment wrapped in condescension. He's saying, the strategy I use requires information access, capital scale, and negotiating power you don't have. Given your constraints, index funds are your best option, which is probably true. But following the advice without understanding the reasoning leads to a specific confusion. People think they're investing like Buffett when they buy index funds. They're not. They're investing the way Buffett thinks people like Buffett should invest. The time horizon problem. Buy and hold forever. Buffett's most repeated principle. For Buffett, forever means something specific. He is 93 years old. He has been investing for over 70 years. His earliest investments have compounded for 7 decades. The mathematics of very long time horizons produce outcomes that shorter time horizons cannot replicate, regardless of strategy. A regular person starting to invest at 35 has 30 years before traditional retirement age. Not 70 years. Not forever. 30 years of compounding produces dramatically different outcomes than 70 years on identical investments. Buffett's results are partly a function of time that regular investors simply don't have. Additionally, Buffett's wealth allows him to hold forever without ever needing liquidity. When you have $100 billion, you never need to sell anything. The dividends alone fund any conceivable lifestyle. Regular people need liquidity. They face job losses, medical emergencies, family obligations, market downturns that coincide with personal financial stress. Holding forever is advice that works when you have so much capital that you never need any of it. It's harder advice when a market decline coincides with a job loss and your investment account is your only financial buffer. The information advantage he doesn't mention. Buffett talks about reading annual reports, doing homework, understanding businesses deeply before investing. He implies this is accessible. Do the research. Understand what you own. Invest accordingly. What he doesn't say, he has access to information, management teams, and analytical resources that no regular investor can replicate. Buffett can call the CEO of any major American company and get a meeting. He has relationships with management teams across industries built over decades. He has analysts whose full-time job is finding and evaluating investment opportunities. When he says he read the annual report and decided the company was undervalued, he also had a conversation with management that shaped his understanding. He also had access to qualitative information about competitive dynamics that isn't in the annual report. He also had 80 years of pattern recognition about how businesses behave across cycles. The regular investor who reads the annual report does not have these things. They have the same publicly available document and none of the context. Following Buffett's stock-picking methodology without his information advantages produces outcomes that look nothing like Buffett's outcomes. The methodology requires the advantages to work. The capital scale advantage. Buffett's investment strategy is specifically designed for large pools of capital. At Berkshire Hathaway's scale, he cannot invest in small companies. The position would move the price too much. He cannot exit quickly. He has to find opportunities large enough to matter to a portfolio his size. This is actually a constraint for Buffett. He has spoken about it directly. His best investment returns came when he was managing small amounts of capital. The returns get harder to maintain as the scale grows. Regular investors have the opposite situation. They can invest in any size company. They can be nimble. They can exit positions easily. They can invest in opportunities too small for Buffett to consider. If Buffett were managing $50,000 instead of $50 billion, he would invest completely differently. He's said so. His advice to regular investors reflects what he would do at their scale only approximately. His actual strategy is designed for his scale, not yours. The psychological gap. Be fearful when others are greedy. Be greedy when others are fearful. This is Buffett's most quoted principle, and the most useless when extracted from his specific psychological and financial context. Being greedy when others are fearful means buying during market crashes, increasing positions when prices are falling and the news is terrible. Buffett can do this because he has essentially unlimited capital. A market crash doesn't threaten his ability to fund his life. He doesn't need to sell anything. He can deploy capital from a position of complete financial security. A regular investor experiencing a 30% market decline may also be experiencing job insecurity in a recession, family financial stress, and genuine uncertainty about their employment future. Buying aggressively during that environment requires not just psychological courage, but financial security that most regular people don't have when markets are at their worst. The advice is correct in theory. It's psychologically and financially inaccessible for most regular people in the conditions under which it's supposed to be applied. The tax situation nobody mentions. Buffett has famously complained that he pays a lower tax rate than his secretary. He's right. And the reason reveals something important about his strategy. Buffett's income comes primarily from capital gains and dividends, not from salary or ordinary income. Long-term capital gains are taxed at lower rates than ordinary income. His strategy is designed to produce capital gains treatment rather than ordinary income treatment. He holds positions for years or decades specifically to qualify for long-term capital gains rates. Additionally, Berkshire Hathaway doesn't pay dividends. Instead, it retains earnings and reinvests them, allowing shareholders to defer taxes indefinitely as long as they hold the stock. The tax efficiency of Buffett's strategy is not accidental. It's engineered. It requires specific investment structures, holding periods, and corporate design that most regular investors don't implement because nobody explains why these choices matter. When Buffett says hold forever, part of what he means is, don't create taxable events. Let the compounding run without the drag of annual tax payments on realized gains. Regular investors who trade frequently, who don't understand tax-efficient investing, who hold investments in taxable accounts without considering tax implications, are following a version of Buffett's philosophy without the tax engineering that makes the philosophy work optimally. What actually applies to regular people? Buffett's principles worth adopting: low cost, broadly diversified, long-term investing in index funds, genuinely applicable. The specific mechanism he recommends for people unlike himself is actually correct. Understanding what you own, applicable at the level accessible to you. You don't need to call the CEO. You need to understand the business model, the competitive position, and the valuation of what you're buying well enough to hold through volatility. Tax efficiency, highly applicable and underutilized. Holding periods, account selection, and avoiding unnecessary taxable events matter significantly for regular investors. Emotional discipline, applicable but requires different infrastructure. Buffett's emotional discipline comes from financial security that eliminates the need for fear. Regular investors build equivalent discipline through automation, cash buffers, and systems that reduce the opportunity to react emotionally. Warren Buffett is the greatest investor in modern history. His publicly stated advice by index funds, hold forever, be greedy when others are fearful, is not wrong. It's incomplete. It's abstracted from a context of capital scale, information access, time horizon, and financial security that the advice itself cannot transfer. Following Buffett's advice is better than following no advice. But following Buffett's advice while believing you're investing like Buffett is a confusion that matters. You're not investing like Buffett. You're investing the way Buffett thinks people who aren't Buffett should invest. That's still useful. Index funds, long time horizons, emotional discipline, tax efficiency, these produce good outcomes for regular investors. Just understand what you're actually doing. You're not replicating the strategy of the world's greatest investor. You're implementing the simplified version he designed for people without his advantages. And that simplified version, executed consistently, is genuinely good. Just not for the reasons most people think, and not in the way Buffett himself actually invests.